In this video, let's look at another balance sheet concept, that is the concept of liquidity. What does it mean for an asset to be liquid? What does it mean for a company to be liquid? And how can we measure a company's liquidity using something called the current ratio? So here's our table of contents, what we'll go over through this video. First of all, if we're going to talk about the current ratio, you need to know what a ratio is. So if you're still a bit rusty about ratios, if it's been a little while since you've studied that, you might want to pause this video and instead watch the Khan Academy video about ratios so that you know what ratios are. We'll talk about what liquidity is and how you can calculate the liquidity for a company using the current ratio. It's a very straightforward mathematical calculation. We'll look at some examples of some real companies. I'll look at numbers from their balance sheets and calculate the current ratios for these two companies and see what that tells us about these companies' financial health. And we'll look at more factors to consider. Once you've calculated the current ratio, your work isn't done. There's more to consider than just that one number. And there are other kinds of ratios we could look at. We'll glance quickly at what some of those categories are. So what is liquidity? Liquidity is the ability or ease with which assets can be converted into cash. So if your company has assets, your company has stuff that's worth something, how quickly, how easily could you convert some of that stuff back into cash? The quality of being able to be converted back into cash quickly and easily is called liquidity. Those are liquid assets. On the other hand, if you're stuck with an asset and you can't convert it into cash quickly or easily, those assets are called illiquid. They are not liquid. Now, I feel this definition needs just a little bit more added to it. I would add that it could be converted into cash at full value, because you could sell things at a discount to get them quickly, but you wouldn't get all your money back quickly. Here's an example of how that works out. Another definition includes some examples here. It says the ease with which an asset can be converted into money. Cash is perfectly liquid because cash already is money. You don't have to convert cash into money. So since cash already is money, cash is perfectly liquid. But shares of stock in a company are less liquid because they must be sold first before the money is obtained. If you own shares of stock in some publicly traded company, you could sell those shares of stock and get pretty close to full market value for your shares of stock, but you'd have to actually bother to sell it. It takes a little bit of time, takes a little bit of effort, and you wouldn't quite get all of your money. You would have to pay a brokerage fee or a transaction fee of some sort. But shares of stock are still very liquid, but not perfectly liquid. You'd have to bother to sell the shares of stock, and you wouldn't get quite all of your money back. Assets such as property are even less liquid because they are harder to sell than shares. So if your company owns property like a building or land or a fleet of cars, and let's say your company decided to sell one of the cars in its fleet in order to get some cash. Well, you'd have to put out an ad that the car is for sale. You'd have to attract a buyer, arrange an appointment for the buyer to come look at the car. The buyer would want to test drive the car. They'll probably have his mechanic look at the car. And after all that, the buyer will probably want to negotiate the price down and maybe not give you everything you're asking for that car. You could sell the car, but not quickly, not easily, and probably not for full value. So an asset like a car is illiquid. You calculate the current ratio in order to measure a company's liquidity. The current ratio is the current assets divided by the current liabilities. That's why it's the current ratio. Current assets, current liabilities, current ratio. So what are current assets and what are current liabilities? Well, each one of those is worth a video of its own to go over what all gets included in those categories. But just very quickly, current assets are the available cash, not reserved cash, but available cash that your company could totally write a check for that cash and the check would be good. In addition, it's the other assets that are not cash yet, but you expect them to be converted into cash within 1 year. So it's the cash you have now and the cash that you're going to get within 1 year, that you expect to get in 1 year's time. So current assets are the cash now and the cash within a year. The other side of that is current liabilities. These are the obligations you need to meet within 1 year. This is the bills you need to pay, the employees whose paychecks you need to pay. If you've taken out a loan with the bank and you have payments to make on that loan, the payments you need to make within this coming year are your current liabilities. So clearly we'd like to have more current assets than we have current liabilities, more funds available to cover the things that we need to satisfy. When that happens, the current assets are going to be greater than the current liabilities. The numerator of this fraction is larger than the denominator, and so that would give us a ratio that is 1.0 or greater than 1.0 if the assets are greater than the liabilities. And that's good. We want the current ratio to be 1.0 or greater. That means we can satisfy all our obligations within this coming year with assets that we expect to get within the coming year. On the other hand, if we have more liabilities than we have assets, the denominator will be larger than the numerator, and our current ratio will be less than 1.0, and that's a sign that there's some kind of a distress. We need to look more closely into what's going on and find out what we're going to do to fix that. So let's look at the current ratios for two actual companies you've probably heard of. One of them is FedEx Corporation. I actually got their balance sheet from their most recent annual filing with the SEC, their Form 10-K, and it said their fiscal year ended May 31st. I'm recording this video at the end of July, so this information is about 2 months old. Their current assets was 11989, but at the top of the balance sheet said that's in millions of dollars. 11,989 is actually $11,989,000,000 of current assets. Current liabilities is 8,008, but again in millions of dollars is $8,008,000,000. If you do the math on that, 11,989 divided by 8,008 comes out to 1.5. So that's greater than 1.0. The FedEx could satisfy all its current liabilities using just its current assets, and it would have a healthy margin after that. There'd be money left over for emergencies that arise or opportunities that become available. And we compare this year's numbers to last year's numbers, that this seems to be a consistent trend that FedEx likes to have that kind of a margin available. Let's look at the current ratios for Apple. Again, I got the balance sheet from their most recent annual filing with the SEC. Apple's fiscal year ends in September, so that was actually 10 months ago. So these numbers are about 10 months old. Current assets, 89,378, but again in millions of dollars, that's $89,378,000,000 of current assets. Current liabilities, 80,610, it's $80,610,000,000. And if we work the math, we get 89,378,000,000 divided by 80,610,000,000 gives us 1.11 for Apple's current ratio. And that's pretty consistent to what they had last year as well. Apple seems to like to run closer to that 1.0 number than FedEx does. So FedEx's current ratio was 1.50. Apple's current ratio was 1.11. Does that mean FedEx good, Apple bad? Well, not so quickly. There's more factors that we need to consider besides just that one pair of numbers. We need to consider the company's size. FedEx's total assets, their balance sheet said their total assets were $45 billion roughly. Apple's total assets were $300 billion. That means Apple is about 7 times larger of a company than FedEx is. And when your company is larger, you can afford to operate closer to the 1.0 threshold than a smaller company could. Also, we should compare averages within the same industry. FedEx is a shipping company, Apple is a technology company. We should compare shipping companies to other shipping companies and technology companies to other technology companies. If a current ratio is below 1.0, does that mean a company is not going to pay its bills? No, it doesn't mean that. It just needs to supplement its current assets with some other sources. They could sell some non-current assets, even if it takes a loss when they sell those. They could get a new loan from the bank to cover their short-term obligations. That's not good for their long-term health, but it could let them meet their immediate needs. Or they could issue more shares of stock. That's another way a company might generate funds. There are other kinds of ratios besides just the current ratio. Other liquidity ratios include these liquidity ratios. We may look at them another time. And there are other categories of ratios: solvency ratios, activity ratios, profitability ratios. And there are about a dozen or more ratios in each of these categories, and all of them tell us something a little bit different about a company's financial health.